All right, let's jump right in. Today, we are digging deep into institutional options flow to figure out what the big money is really up to. Because right now, the data is telling two completely different stories at the exact same time. One story is about wild, runaway optimism, and the other is about some serious caution. Let's get into it. This quote from the analysis really says it all. On the surface, yeah, the party is absolutely in full swing. It looks like a massive rally. But if you look just beneath that surface, the smartest players in the room, well, they're not just popping champagne, they're also quietly checking where all the exits are. And that's the core conflict we're going to unpack. So here's how we'll break it down. First, we'll frame these two competing stories. Then, we'll dive into the data for the bull case and then the bear case. After that, we'll see how this whole drama is playing out in the crypto world, and then we'll wrap it all up with a final conclusion. Okay, so let's get into this high-stakes battle. And I want to be clear, this isn't just your everyday market churn. What we're seeing are two incredibly powerful opposing forces, and both are deploying massive amounts of capital, betting on completely different outcomes. And if you want to get a sense of the scale here, you just got to follow the money. We've identified over $30 million in premium being spent on bullish bets, basically chasing the upside. But fighting against that, you've got over $15 million being deployed for bearish positions or hedges. The real story here is the sheer size of these bets. These aren't small flyers. This is a true heavyweight fight. All right, so first up, let's talk about the bulls. Right now, the dominant story, the one you hear the most about, is this overwhelming momentum-driven buying frenzy. For a lot of institutions, the path of least resistance just seems to be up. And you can feel the urgency in the bull case. I mean, check this out. A staggering $11.7 million spent on SPY weekly call options. This isn't some long-term strategic bet, no. This is a massive wager on an immediate, almost explosive move higher. It's really the textbook definition of institutional performance chasing. This bullish feeling isn't just everywhere either. It's laser-focused on tech. We saw a single block trade of $9.3 million on NASDAQ 100 calls, the QQQ, for October. A bet that size tells you there's some deep institutional belief that tech is going to keep leading the charge for the rest of the year. And it's not just the indexes. The money is just flooding into specific mega-cap leaders. I mean, Google alone has pulled in over $14 million in premium just for its September calls. This shows you that institutions aren't just buying the market. They're actively piling into the names they see as the big winners. And, this confidence is getting pretty wild. In Tesla, we saw a nearly $2 million bet on long-term leaps calls that need the stock to more than double just to break even. That's incredible. And look at Nvidia. An early $7.1 million bearish bet got absolutely steamrolled by a later $8.5 million bullish call purchase. The bulls are not just showing up, they are fighting hard to control the story. Okay, so now let's flip the coin and look at the other side of this market. For every institution that's chasing momentum, there's another sophisticated player out there buying what looks a lot like insurance. This is the other story, where the smart money seems to be preparing for a potential storm. And these aren't just some vague feelings of worry. These are specific, targeted hedges. We're seeing a $3.7 million put purchase on the SPY for broad market protection. What's even more telling is a $1.3 million bet against the IWM, the small cap index. See, the IWM tracks smaller, more domestic companies, so it's much a purer bet against the U.S. economy itself. And then, to top it all off, you've got over $1.4 million betting on a spike in the VIX, the market's fear gauge. So remember all that bullish money pouring into Google for the short term? Well, if you look further out, the story gets a lot murkier. This slide basically shows a battle of the whales. You've got one institution spending a massive $8.1 million to buy long-dated puts, a huge bet on a decline way down the road. At the same time, another institution collected $5.2 million by selling those exact same puts, betting that a drop like that just won't happen. It's a huge multi-million-dollar disagreement on where the company is headed.
Now for maybe one of the most glaring bearish signals we've seen. We're going to look beyond options to the actual stock transactions from insiders at Coinbase. And this isn't a hedge, but it is a powerful clue about sentiment. As you can see, the sales just dwarf the purchases. We're talking $7.5 billion worth of stock sold by insiders, the people who know the company best, while they've only purchased about $136 million. That kind of imbalance, it's a pretty clear vote of no confidence from inside the building.
So you've got these two massive forces, right? The bulls and the bears. So where does it all come to a head? Well, you can see the whole conflict playing out in miniature right in the crypto space, and specifically in the IBIT Bitcoin ETF. It's a perfect case study. The IBIT Bitcoin ETF just perfectly sums up this whole conflicted market. As you can see, the flow is overwhelmingly bullish. You've got calls making up about 84% of the premium, which is $3.8 million in bets on a continued rally. But here's the kicker. Look at that other slice. That 16% represents over $700,000 in bearish puts. So even in one of the hottest tickets in town, sophisticated players are actively hedging against a drop.
Okay, so we've looked at the bulls, we've looked at the bears. What does it all mean when you put it together? Let's boil this all down to a final data-driven takeaway.
The big conclusion from all this data is that the market is just really, really fragile right now. This isn't some healthy, slow and steady bull run. The mix of this aggressive momentum-chasing bullishness with these large-scale strategic hedges, it creates a fundamentally unstable environment, one that could be very susceptible to a sharp reversal. And that really brings us full circle. Yeah, the momentum could absolutely keep pushing us higher for a bit. The bull case is huge. You can't deny it. But that hedging we're seeing, it's not just pocket change. It's big, it's smart, and it's being put on by people who really don't like to lose money. To ignore that would be a huge mistake.
So we're left with this one critical question. The data shows that the smart money has already bought its insurance policy. The protection is in place. The only thing we don't know is, what's going to be the catalyst that triggers the claim? What do you think it will be?